clearing exemption. The amendment is identical to the House bill, which passed the House by a vote of 370 to 24. Is it accurate, in your opinion, that regardless of congressional intent, the banking regulators view the plain language of the statute as requiring them to impose some kind of margin requirement on non-financial end users unless Congress changes the statute?
We believe that the statute does require us to impose some type of margin requirement. We try to mitigate the effect as much as possible by allowing for exemptions when the credit risk associated with the margin was viewed as being sufficiently small. So many small end users would be exempt in practice.
Do you agree that the non-financial end users hedging does not contribute to systemic risk, that the economy, the economic benefits from their risk management activity, that the economy benefits from their hedging activity, and that it's appropriate for Congress to provide an explicit exemption from margin requirements for non-financial end users that qualify for the clearing exemption?
I certainly agree that non-financial end users benefit and that the economy benefits from the use of derivatives. It seems to be the sense of a large portion of the Congress that that exemption should be made explicit, and speaking for the Federal Reserve, we're very comfortable with that proposal.
Well, thank you, Mr. Chairman. I want to shift gears for just a minute back to the question that the Chairman asked with regard to what actions you can take. You indicated in your response to his question about what tools you still have and how you may approach them, that you still have some possible tools to deal with. There's obviously a lot of speculation and concern about whether you are considering another round of quantitative easing. There are a lot of questions about how effective the quantitative easing has been to date and what more can be done. Could you discuss for us a moment how you feel, how effective you feel that the quantitative easing has been so far, and whether you feel that it is one of those tools that you should seriously consider going forward?
So as I mentioned to the Chairman, we ran out of space to lower short-term rates in the normal way, and we had to look for other tools. Like a number of other major central banks, we've used asset purchases as a way of providing additional support to the economy. Economists differ on terms of how effective the tools have been. My own assessment is that the quantitative easing and the Operation Twist so-called tools have been effective in easing financial conditions and in promoting strength in the economy. I think it was most evident in the so-called QE1 in March 2009, which was followed a few months later by the beginning of the recovery, and by a few days by the trough in the stock market. QE2 was certainly effective at addressing what was beginning to become a worrisome amount of risk of deflation in the fall of 2010. That issue was addressed. My view and the view of our analysts at the Fed is that it also contributed to economic growth. It's hard to judge because it depends on what you think would have happened in the absence of those actions. So there's a range of views about the efficacy of these programs. There's also questions about side effects, risks that might be associated with their use, and therefore I think they shouldn't be used lightly. Nevertheless, my own view is that these tools and other non-standard tools still do have some capacity to support the economy. And what we'll be looking at in thinking about this is, I think, really two things. The first is, as mentioned in our statement, whether or not there is, in fact, a sustained recovery going on in the labor market, or are we stuck in the mud, so to speak, in terms of employment. That's, of course, our maximum employment mandate. And then the other issue would be price stability, and notably, we would certainly want to react against any increase in deflation risk.
Thank you.
Senator Reid.
Thank you very much, Mr. Chairman, and thank you, Chairman Bernanke. Let me return for a moment to the issue of LIBOR. Can you give us and the millions of Americans that depend upon LIBOR, because it tells them how much they have to pay for their car loan or their student loan, et cetera, that the current LIBOR is reliable, that the changes that were made or suggested by the New York Fed or others have been put in place, and that this is an index that is, in fact, reliable and not being subject to manipulation going forward?
I can't give that assurance with full confidence because the British Bankers Association did not adopt most of the suggestions that were made by the Federal Reserve Bank of New York. They made relatively small number of changes. I think it's likely that the concerns are less now because we're no longer in the crisis period, and that, as I mentioned, was a period in which transactions at many maturities were not taking place. I would like to see additional reforms to the LIBOR process, assuming that LIBOR will continue to be a benchmark for financial contracts. Alternatively, there are a number of people looking at alternative benchmarks like repo rates or the overnight index swap rate or other types of interest rates, which have the advantage over LIBOR that they are market rates as opposed to simply reported rates.
What steps are you taking, though, given that concern you've expressed right now, not retrospectively how we got here and who did what to who, but to provide as much certainty as you can? There are several banking institutions you directly regulate that contribute to LIBOR. There is your relationship directly with the Bank of England. What are you doing, not just you personally, but the Federal Reserve, to ensure this index is appropriate? And again, I encourage you to study these alternatives, but the LIBOR is so deeply interwoven and embedded into thousands and thousands of contractual arrangements throughout the world that it's going to be hard to next week shift to something else.
Well, again, I think we are and need to continue advocating for reforms to the LIBOR process. It is constructed by a private organization in the UK, and so our direct ability to influence that is limited. With respect to the 3 banks in the United States which contribute to the LIBOR panel, 2 of those banks have reported in their SEC filings that they have been asked for information by investigating agencies. We are following that very carefully. We'll see what happens, and we will provide any support and help we can to those investigators.
Let me turn to the more the monetary issue. And the Federal Reserve has been, in some cases, sort of pursuing aggressive monetary policy while fiscal policy. If we reach a solution that is heavy on cuts to spending, that is heavy perhaps even on cuts to entitlements, that would not provide stimulus, in my view, and it could further impact unemployment in the country. Is that an accurate assessment? Well,
the position we've taken is, I would say, at a first cut, is do no harm. What we need is a strategy which addresses the long-run sustainability issues. We can't forget about that. At the same time, if the fiscal cliff is allowed to happen, it will certainly have major negative effects on the recovery. The CBO, the IMF, and many other observers have made similar recommendations, and we feel that's a reasonable balance between the short and long term.
But some of the specific issues that we face at the end of the year are filling a gap in the 2013 in terms of spending, in terms of revenues. And if that 2013, if we avoid the cliff by taking another route, but that route is significantly decreases spending decreases other stimulative effects, would your view be that we could have avoided a cliff but still found ourselves in a very perilous economic situation because employment will continue to decline?
It's a question of the time frame. In the very near term, we already have a lot of fiscal drag coming from state and local governments, for example, as you know,
right,
and some coming from, inevitably, from the federal side. In no way am I saying that we shouldn't be making strong efforts to achieve long-term sustainability and make a credible plan as soon as possible for doing that. But it would be better to make that plan soon, but to have the effects come in more gradually to allow the recovery, the air it needs in the short term.
Thank you, Mr. Chairman.
Senator Corker.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being here. I was listening to the last dialogue there, and I know in your statements you talked about the fiscal cliff that's coming up, and to be clear about the spending reductions, it's $1.2 trillion over the next 10 years that the sequestration amounts to. We're going to spend about $45 to $47 trillion of taxpayer money over the next 10 years. And while I agree we should come up with a much better solution that deals with entitlements and revenues and hopefully something that's much larger, are you seriously concerned that, we're talking about $108 billion next year in reductions, half between defense, half and other mandatory spending? You're seriously concerned that that small amount of spending reductions is something that's going to damage the economy?
The fiscal cliff includes both the spending reductions and the tax.
I'm talking about just the spending piece. It's hard for me to believe.
Obviously, a smaller fiscal contraction will have a smaller effect. But I don't want to make a judgment about. I realize it's very contentious, taxes versus spending. I don't want to get into that. But clearly, a smaller reduction in the fiscal position would have less effect in the economy than a larger one.
Yeah. But as we look at the economy, would you not also say that the best thing we could do to stimulate the economy, including any actions the Fed might take, is for us to have real balanced fiscal reform? Is that not the thing that would cause our economy to take off more than anything else and alleviate the uncertainty that people have, that the investing community?
Fiscal reform is very important, not only the control of deficits over the long period, but also the quality of fiscal policy. What are we spending our money on? What does our tax code look like? I think those things are extremely important. But I think the way the current law is written, we have the maximum impact right in the very short run on January 1st, 2013, and much less happening over the next decade or the next 2 decades. Mm-hmm. So I'm not advocating an overall increase in fiscal spending or anything like that. I'm just saying that the timing should be adjusted to allow the recovery a little bit more space to continue, but to make a serious effort to improve our fiscal policy over the next decade.
Yeah, so look, I agree that we should have a better policy than we now have, and I think most of the people on this dais are trying to seek that, and it's unbelievable to me that we haven't already done that. But I think, on the other hand, for us to potentially kick the can down the road on sequestration creates even more, if we don't come up with another solution, which I hope we will. But to say that you are recommending, in some ways, that we kick the can down the road, not do sequestration, and make us look even more irresponsible, to me, is worse than the $108 billion that might be reduced out of the spending that the federal government's going to be doing this next year. Do you understand what I'm saying?
Yes, sir, and I think just delaying everything, just saying we're not going to do it, put it off a year, I think that'd be a very bad outcome.
So I think the actions that you're taking at the Fed, and I understand you have a dual mandate. I think we should have a single mandate, and I know we've talked about that. I know that it creates bipolar activity because you're trying to juggle the two, and we've created that, not you. But I think the actions that you're taking really take or you're potentially considering, I know QE2 was in response to potential deflation. I think further actions actually take the impetus off us to act responsibly. And I candidly wish we had a chairman of the Fed that sometimes it would say, look, we're not doing anything else. We're pushing rope. and it's up to you to act responsibly to deal with these fiscal issues. Quit looking to us. I mean, are you tempted ever to say that to Congress? Would you not say that now?
I don't think that's my responsibility. I've been assigned to focus on maximum employment and price stability, not to hold threats over Congress's head. Congress is in charge here, not the Federal Reserve.
Very politic answer. I would say that you know, you have members that are concerned about the policies that you're putting in place being disruptive. You do have members who are concerned about that. Is that correct?
We have a range of views on the committee, yes.
And let me ask it a different way. If we were to act responsibly and to do something in a balanced way that dealt with not only the next 10 years but the 20 and 30, which most of the plans that have been in the mainstream do that, would that alleviate the need, possibly, for the Fed to consider additional quantitative easing?
Well, possibly. As I said, the fiscal issues are a major concern, a major downside risk, and if Congress addressed those issues so the economy was, the outlook was better, then it's certainly very possible that that would abrogate any need to take further action.
You've been a little vague on what additional tools that you have, and I understand that. I know the whole world watches when you speak. It does appear that most of the toolkit is utilized at this moment. If you were to consider additional tools at the Fed in the next meeting, what would be the range of options that might exist with rates being where they are today and Operation Twist being in effect? I mean, what else is there that the Fed can responsibly do, since the Fed is the biggest lender to the federal government already, far more than China and Japan?
Well, there are a range of possibilities, and I don't want to, you know, give any signal that we're choosing one among the other.
But what is
the logical range? Includes different types of purchase programs that could include treasuries, or conclude treasuries and mortgage-backed securities. Those are the two things we're allowed to buy. We could also use our discount window for lending purposes, but you know, that's another possibility. We could use communication to talk about our future plans regarding rates or our balance sheet. And a possibility that we have discussed in the past is cutting the interest rate we pay in excess reserves. That's a range of things that we could do. Each one of them has costs and benefits, and that's an important part of the calculation.
Thank you for your service and being here.
Senator Schumer.
Well, thank you, Mr. Chairman. I, too, thank you for your service. I think you've done a superb job in one of the most difficult periods to be chairman of the Fed. Now, I don't quite agree with my good friend, Mr. Corker. I think you have told Congress what you want us to do in your own Fed-speak way of doing it. Just last month, you said, quote, you'd be more comfortable if Congress took off some of the burden in terms of helping the Fed in our economic recovery. What he meant there is not deficit reduction. He meant stimulus. He meant some kind of stimulus, which is the opposite side of the Fed. Now, I agree with you. Under current conditions, fiscal policy should be our first choice. It would be more effective. Unfortunately, we can talk all we want. Everyone gives speeches how fiscal policy should be the way to go, and we don't do anything. We've had a hard time getting the cooperation necessary to get anything done on the fiscal side. We've tried tax cuts, which supposedly our colleagues on the other side of the aisle like. We've tried increased investments in infrastructure, a traditional way of priming the pump. We've tried support for state and local governments where jobs are declining, and we've run into opposition on all fronts. Just last week, on two things that our colleagues have often supported, a tax credit for job creation and accelerated depreciation for capital purchases, we got no support. So the bottom line is very simple. We're not going to get the fiscal relief we want, at least over the next short while. Maybe after November we will. So given the political realities, and the President has been calling for this repeatedly, when the President last fall proposed short-term fiscal support combined with long-term deficit reduction, which to me is the right way to go, a 10-year plan that really reduces our deficit, but a 1- or 2-year plan that pumps the economy up a little bit, he didn't get a single vote, single Republican vote. And we know the reality. Can't do it if it's not bipartisan. So given the political realities, Mr. Chairman, particularly in this election year, I'm afraid the Fed is the only game in town. And I would urge you to take whatever actions you think would be most helpful in supporting a stronger economic recovery. You've received some harsh criticism for past efforts to help the economy. Republican leadership in the House and Senate, even as they were blocking jobs bills in Congress, sent you a letter opposing more monetary support as well. Well, I would urge you now more than ever to take whatever actions are warranted by the economic conditions, regardless of the political pressure. To that end, the minutes of your last FOMC meeting notes that the forecast for real GDP growth was revised down, the unemployment rate remained elevated, and consumer price inflation declined. Moreover, the economy showed that not a single member of the committee thought employment would be back to normal levels by the end of 2014. Not a single member forecast inflation even modestly above your 2% target in the same time frame. So the recession is deeper, more prolonged, and stickier than anyone thought. And let's remember, the Fed has a dual mandate. First and foremost, to guard against inflation, but also to keep unemployment up to keep employment up and unemployment down. So to me, these conditions would certainly motivate the Fed to seriously consider taking further action to bolster the economy. What's your opinion about that?
We take the dual mandate very seriously. We will act in a apolitical, nonpartisan manner to do what's necessary for the economy. We have said we're prepared to take further action. The complication, of course, is that we are dealing with less conventional tools, and we have to make assessments about their efficacy and whatever costs and risks may be associated with them. But it's very important that we see sustained progress in the labor market and avoid deflation risk, and those are the things we'll be looking at as the committee meets later this month and later this summer.
And you still do, I mean, you've used QE1, QE2, but you still have some other tools in your toolkit.
I believe we do, yes.
Okay. And do you agree that at least for the next few years, the danger of inflation is quite low?
Well, our projection of inflation is that it will be close to or below our 2% target. And, yeah, so I think inflation risk is relatively low now. Not everyone agrees with that, but my personal opinion is that that risk is reasonably low right now. And indeed, as I mentioned, there's a modest risk, not a large risk, but a modest risk of going in the other direction, which is towards the deflationary side.
And you certainly agree that unemployment has been too high and is sticky, and despite two false starts, we're having a much rougher time than we ever imagined getting unemployment down.
Yes, that's true.
So get to work, Mr. Chairman.
Senator DeMint.
Thank you. Thank you, Mr. Chairman, for being here. It's interesting to hear my colleagues talk, and they seem puzzled why our short-term temporary stimulus gimmicks don't seem to work. And by any analysis, the cliff that's at the end of this year was created by all of these temporary policies that expire at the same time. Clearly, we're throwing a lot on you, but at the same time, it appears that we're forcing you into kind of temporary, short-term ideas. And I'm concerned that, as you've mentioned cost and benefits, that some of the things that you're clearly considering, such as quantitative easing, has costs that we don't talk about, at least on our side, as well as keeping the interest rates low. I mean, you're well aware that keeping interest rates where they are costing Americans about $400 billion a year in lost interest on any savings that they might have. So there is a real cost, and over the last 4 years, probably about $1 trillion in loss. So people who are actually trying to save and put aside dollars are on a negative treadmill in the sense that they're losing the value on their dollars. So there's a cost to that stimulus effect. And also quantitative easing, which you're clearly considering. Our own Federal Reserve Bank of New York estimates that about 50% of the value of S&P over the last decade is related to Fed action and the buildup around Fed action of quantitative easing. And My concern now is that what we're seeing is not an increase in the value of stock, but a projection in the loss of value of our dollar. And while we talk about no inflation, I think what we're talking about is no visible inflation at this time, because clearly if we're printing more money to buy more of our national debt, and I think you'll agree the Federal Reserve through intermediaries has bought over half of our debt the last couple of years, we are diluting the value of our dollar over time. And while it may not show up today or tomorrow, it's inevitable that it will show up, and I think we see that in the reflection of the price of stocks, because it's obvious that that doesn't reflect long-term projections of value and profits as much as it does playing a market in what is coming out of the Federal Reserve. So my concern very much now is another announcement of quantitative easing, which might inflate the stock market temporarily, but another short-term effort that might help employment in the short term, but actually reduce the value of the dollar and therefore everything we work for here in the country. And so how are you gauging the cost of another round of quantitative easing?
Well, let me respond to the specifics that you raised. On savings, we understand that low interest rates are hardship for many people. But the reason that interest rates are low, of course, is that we're trying to promote a recovery in the economy. People who save hold fixed income types of securities like CDs or Treasury bonds, but they also hold stocks or corporate bonds or small businesses or other types of assets which depend on the strength of the economy. And if raising interest rates might help some folks, but if it caused the economy to weaken considerably, it would be bad for investors, broadly speaking. So what we're trying to do, of course, as our mandate suggests, is to strengthen the economy, which in turn should make America a more attractive place to invest, provide higher returns for everyone investing in the United States. On the dollar and inflation, I appreciate your concern, and that's one, and that's obviously one of the things we pay very close attention to. We have not seen inflation yet, though, and the dollar has been, in fact, recently a good bit stronger. And we are comfortable that we have the tools to unwind these policies in a way that will not threaten inflation. But we take, as I said to Senator Schumer, we take both sides of the mandate very seriously, and as we are looking to try to help reduce unemployment, we also want to be confident that we maintain price stability in the United States, and thus far we've been successful at doing that.
The dollar is stronger relative to the euro, but comparative values inside the United States, it just caused some concerns at this point. But again, I appreciate what you do. I would just ask caution in diluting our dollar even further for temporary action. Thank you, Mr. Chairman.
Senator Menendez.
Thank you, Mr. Chairman. Thank you, Chairman Bernanke, for your service. I want to speak to you about interest rate manipulations by large banks, since the Fed plays a key role in ensuring the integrity of interest rates that affect consumers, small businesses, and cities and towns across the country. You know, I look at these most recent set of allegations on the LIBOR manipulation, and once again it exposes to me a culture of greed, a culture of cheating, of lying, at least at one large bank, and probably many more, which is why 9 of my colleagues and I wrote to you and other banking regulators and the Department of Justice last week asking for a robust investigation in the role of these banks and how this ultimately affected consumers in this country, investors in this country, cities in this country, because LIBOR is it's far more than a benchmark. It's a very significant indicator here that's used. I know that the Federal Reserve Bank of Cleveland found that 45% of prime adjustable rate mortgages are indexed to LIBOR. 80% of the subprime ARNs use LIBOR as a benchmark. So this is a huge issue, and it again goes to the integrity of our financial system and the lack of faith, I think, increasingly that the American public, and for that fact many of us, are having in a system. I look at the internal emails during 2005 and 7 of Barclays derivative traders asking other employees to submit false survey responses in order to benefit their trading positions, changing them, preferring certain LIBOR outcomes on certain days, sometimes for it to be higher, sometimes for it to be lower, depending upon how it would benefit their position. Now, I look at this and I say to myself, this is about trying to manipulate a key economic indicator for the purposes of profit. Am I wrong on that?
No, I agree absolutely. This is unacceptable behavior.
Well, let me ask you, clearly then banks like Barclays were trying to profit from the LIBOR manipulation, but that profit came not actually it came at the expense of the public in general.
Some of the public, it's actually an interesting question. You mentioned borrowers. Borrowers may have benefited because LIBOR was underreported. We'll probably find out via a number of lawsuits that have been filed and investigations.
But if you got caught in that period of time in which the traders wanted the higher LIBOR, and that was a time in which your adjustment was going on, you had a detriment to yourself. Investors obviously had a detriment in not knowing the integrity of the institutions, not knowing the LIBOR. If it's lower, it means things are working pretty well. When it goes higher, it's sort of like a warning sign, is it not?
I'm not defending it. I think it's a major problem for our financial system and for the confidence in the financial system, and we need to address it.
Well, so how do we address it? For example, I know that some of my colleagues here bristle at regulation, but it seems that this is an industry that on its own won't work with the integrity that the public deserves. I mean, we're talking about pension fund investments, mutual fund investments, investments by regular investors, as well as the consequences to consumers. I'm sure that we're talking about billions in effect, if not trillions in effect. So, for example, do you think that we need additional internal controls or firewalls between reporting personnel and trading employees at these banks so that we don't have this work to manipulate? As one example of, I'd like to hear, what is it that we are going to do now that we know all of this and may have known it before? What are we going to do to ensure the integrity of this banking system?
Well, first, it's going to have to be an international effort because this is a British LIBOR is constructed by this UK organization, and of course, LIBOR is constructed for about 10 different currencies as well. So it has to be an international effort. I think there's broadly two approaches. One would be to fix LIBOR, to make changes to it, to increase the visibility, to reduce the ability of individual banks or traders to affect the overall LIBOR, and to increase monitoring of the reporting process that is done. So that'd be one strategy. The other strategy, which many people are thinking about, is going from what is essentially a reported rate to a observable market rate as the index, and there are a number of possible candidates that have been advanced that might ultimately replace LIBOR. As you point out, though, LIBOR is very deeply ingrained in many contracts, and so that change will be not a simple one to make. But I agree with you that we need to address this problem.
Well, I'd look forward to the Fed's leadership in this regard, the suggestions of how we, in fact, make a system that cannot be manipulated, that has consequences to millions of consumers, investors, pension funds, municipalities, counties, governments, all affected by LIBOR. And so it may be an international response that we need, but we need to understand what we can do here in the United States to ensure for these investors and these consumers.
Senator Berger.
Thank you, Mr. Chairman, and thank you, Chairman Bernanke, for your report. On the LIBOR issue, from everything I've read, reports as well as documents, it seems like in 2008, when the New York Fed learned of this potential scandal, potential misreporting, it reacted on the policy side with various discussions, recommendations with their British counterparts. I haven't seen anything about it reacting as a regulator of U.S. large banks. Did it do anything to investigate whether U.S. banks were guilty of the same practice?
Well, what it did was it informed the responsible authorities, the CFTC in particular, very quickly. The Bank of New York made a presentation to the President's Working Group that included the SEC and the CFTC, provided supporting information, as did the board. So the investigations took place, but they were taken up quite quickly by not the Fed, which is a safety and soundness regulator, but by the authorities that had the most direct responsibility for those issues. I don't know. I have to say that the Federal Reserve Bank of New York is still investigating the situation itself, digging up documents and the like. I don't know what communications or conversations were had with the 3 U.S. banks who were on the panel, but the actual enforcement actions were taken by CFTC and SEC and
So
DOJ.
as we sit here today, do we know definitively that no U.S. banks were guilty of the same manipulation?
No, we don't know that.
Well, it seems to me that goes back to my question, my concern. If we don't know that, it seems like somebody dropped the ball. The fact that we're 4 years later and we don't know that.
Well, I mean, as I said, two banks have reported that they've been asked for to disclose information to the investigating agencies, and so the process is certainly, robust process is certainly underway.
It's underway 4 years later. My point is that knowledge of this occurred in 2008, and neither the New York Fed nor other regulators did a sufficient investigation so that we could know one way or the other, as we speak today 4 years later, that the U.S. banks didn't do the same thing. Am I missing something?
Only that, again, I think the responsibility of the New York Fed was to make sure that the appropriate authorities had the information, which is what they did.
You think it was a reasonable responsibility for the New York Fed to follow up and say, did U.S. banks that we're a primary regulator of do the same thing?
I don't know what conversations they had. Of course, the New York Fed is the regulator of some banks and of holding companies. There are other regulators like the OCC and so on.
But certainly the New York Fed is a primary regulator of the biggest banks with regard to U.S. banks engaged in LIBOR that we're talking about, correct?
2 of the 3.
Right. Let me move on to another topic that I'm concerned about. The Fed is in the process of rulemaking with regard to the term, quote, predominantly engaged in financial activities, close quote, under Dodd-Frank. Mm-hmm. The rule that's been published, and the Fed is now taking comments on, seems to me absolutely ignores a very specific criteria that we in Congress placed in Dodd-Frank in Section 102A6. It was I know about it because it was a Vitter-Pryor amendment, and it's very specific. It uses an 85% test. And it seems to me the rule the Fed is in the process of adopting ignores that specific metric. How can the Fed adopt a rule that ignores specific statutory language?
We wouldn't want to do that, and I will check on that question for you.
If you could check on that, again, it's 102A6, and I believe the Fed rule that's been published for comment ignores a specific metric in the law, which I would short-term call the 85% rule, which was a Vitter-Pryor amendment, which is in final law.
Thank you for that.
Thank you very much. Finally, capital standards for the largest banks. As I've read your comments in the past, it seems to me that you support somewhat larger capital requirements for mega banks, but that you seem to think where we're headed, about 9.5% under Basel III, which is about 2.5% more for the mega banks, is roughly appropriate. Is that a fair summary or not?
Well, there's an international standard which has a gradated, it's not the same for every big bank. It starts at virtually zero for the medium-sized banks, then goes increases up to the largest banks. But it's based on some formulas and some calculations that try to establish parity across banks around the world.
I guess what I'm asking is that high, to the extent that imposes higher capital standards on the largest U.S. banks, do you think those higher standards are good enough to ensure stability in the future and protection in the future?
I think they're very useful, very important. Basel III in general is going to increase everybody's capital and increase the quality of capital, and this will mean that the largest banks have even additional capital. But it's not just capital, it's also going to be the market discipline that comes from orderly liquidation authority, stronger supervision, liquidity requirements, and so on. I think it's extremely important that we address too big to fail, and this is one way to make banks take into account that their own size does impose a cost on the rest of society and make them respond to that.
Beyond the path we're on, do you think we should be looking at higher capital requirements for the biggest banks?
Well, we'll continue to have international discussions. It's been our approach to try to have capital requirements that are broadly consistent with the international standards. And these numbers were based on calculations that drew from the crisis. But we're always open to further discussions, and we'll see how effects of the higher capital work through the credit system as we go forward. We're phasing this in relatively slowly, as you know. So we'll get a chance to see what the impact is on banks and credit costs.
My time is up, but I'd encourage you to look at that, and I'd encourage you to place safety and stability ahead of, I understand the desire for uniformity across the globe, but I don't think it should trump what is best for...
You're looking for higher capital requirements.
Yes.
Senator Kaka.
Thank you very much, Mr. Chairman. Let me add my welcome to Chairman Bernanke to the committee, and to thank you so much for your tireless leadership in these challenging times. Recent economic events in Europe and China show us how dependent the United States is on the international markets when it comes to our economic recovery. Despite concerns about the overall rate of recovery, some sectors are beginning to turn around, and we're beginning to see some bright spots, as indicated in your opening statement. Hawaii, for example, had record tourism numbers in May. And nationally, we see spending by foreign travelers continue to rise, helping to reduce our deficit. My questions are, how do you think that current policies and those regarding tourism and exports have affected the recovery? And also, do you have any suggestions on how to further encourage growth in these areas?
Well, first, Senator, tourism has been something of a bright spot. It has been, we've seen improvements in tourism in lots, not just Hawaii, but in a number of places around the country. And you mentioned the international trade deficit. People may not appreciate that when a foreigner comes and visits Hawaii, that actually counts as a U.S. export, because we're exporting the tourism services. And the export of tourism services has actually been growing very quickly, something like 14% last year, faster than other types of exports. And so it contributes to our trade balance as well as to overall economic activity. So it is a positive. With respect to policies that address it, I think there's a lot of incentive. We see that individual states, for example, compete with each other to try to attract visitors. But we can consider issues like visa policies. We can, look at any tax or other implications that might affect the cost of tourism. So it's an area where I think there's a lot of benefit, a lot of scope for economic benefit to Hawaii and the rest of the country, and it has so far been, as I said, a bright spot in among the various service industries that we have.
Thank you. As you know, I'm concerned with the well-being of consumers. During previous hearings, you and I have discussed the importance of improving financial literacy to empower consumers while we work to grow the economy. So my question is, what ways have you seen financial decision-making by individual Americans improve during this recovery, and what more needs to be done, you think?
Well, there's two sides to improving decision-making. On the one hand, there's education, and that effort is continued. The Federal Reserve is continuing its efforts towards promoting financial literacy and economic education. I have an upcoming meeting with teachers across the country, and I'll be talking about financial literacy and answering their questions and talking about how to introduce students to these topics. Some of the activities that we had have moved over to the CFPB, which some personnel and some functions went over there, but they are also engaged in those activities. So education is one side, and the other side, it's important that disclosures and the types of products that are offered are such that people have a reasonable chance of understanding what it is that they're buying or investing in. The Federal Reserve pioneered, a few years ago, it pioneered the use of consumer testing to improve disclosures for credit card statements and a variety of other types of disclosures, and we hope to see that type of activity continue. I think in general that the experience of the crisis has made many people more aware of the need to be financially literate, schools more aware and more cautious as well. But it's an ongoing battle. It's not something that we can, declare. We can't declare victory. We have to continue to work to try to make sure that both kids in school and also adults who are making financial decisions have access to good advice and good education.
Thank you very much for your responses, Mr. Chairman.
Senator Johanns.
Mr. Chairman, good to see you again. The forecasts that you have testified about today, I'm assuming do not factor in the results of the fiscal cliff that is headed our way between now and the end of the year. Is that a safe assumption?
That's correct.
So because of the fact that all of the various items that are included in the so-called fiscal cliff would take affirmative action by Congress to pull us back, which typically means 60 votes in the Senate, a majority in the House, presidential signature. My assumption is that if that doesn't happen, that we get caught in a situation where those forecasts would be revised yet again, and it would be even more pessimistic than your testimony today. Would that be correct?
Absolutely.
As you think about the sequester, $1 trillion sequester, as you think about returning to the 01-03 tax policy, as you think about the estate tax and all of the various factors that we're looking at between now and the end of the year, is there, if you were to give a recommendation to Congress as where to act, would it be act on everything, or is there a priority that you would set for action?
No, I think the choices between spending and taxes and the mix and the kinds of taxes and so on, I think that's really a congressional responsibility. I'm just pointing to the collective impact of all these different things happening at the same time, and there may be many different ways to mitigate that effect, and I'm sure members of Congress have different views on the best way to do that, which is one of the problems, because you're going to have to come to some kind of agreement. So no, I don't have a specific recommendation other than to think about not just the individual policies, but their collective impact if they all happen at the same time.
Let me talk to you a little bit about the mitigation piece of this. As you know, some of us, in fact, some of us on this banking committee have been
There's only one way to get it all, lunch money. We're talking about
months. In fact, for some members, they've been meeting for over a year, talking about an approach. And I would guess the best way of describing that is the outline for the approach is the Simpson-Bowles plan, which came out a year ago. Thinking about that plan, would you be comfortable in testifying today that that at least is an acceptable alternative to what we're facing between now and the end of the year, if Congress could see its way to adopting that approach?
Well, it does have a profile that seems reasonable in terms of addressing longer-term sustainability over the longer period. But again, I don't want to endorse the individual components, in part because, again, choices between taxes and spending are a congressional prerogative, and also because the Bowles-Simpson plan doesn't, it's not really a complete plan. It doesn't, for example, say very much about health care and how those costs will be controlled. But it does have the feature that, like many other plans that have been suggested, and there are others, Rivlin and others as well, that introduce this discipline, fiscal discipline, in a rigorous way, but over a longer period of time to allow the economy to adjust, more easily.
Mr. Chairman, I think if the average citizen were to listen in on the political debate that will occur between now and November, and political debate is certainly appropriate, that's how democracies work, you would get very discouraged. But having said that, give us your thoughts. If Congress were able to put a plan in place, whether it's Bowles-Simpson or another approach that provided that stimulus maybe for a period of time, in my judgment, pull back on the sequester, provided economic stability in terms of tax policy and revenue policy, and started stabilizing things with a view toward trying to deal with the deficit over a period of time. What kind of signal would that send to the marketplace, and do you think that would be a positive signal?
It would be very positive. It would reduce a lot of the uncertainty that we see. It would address a very important problem, and it would show the ability of our political system to deliver important results. You may recall that when the United States government was downgraded last summer, the putative reason was the concern about the ability of Congress to come to a solution, not a lack of resources for the country as a whole, but it really was this issue about whether the Congress can work together to deliver a satisfactory outcome. So I think something like that, even if it was only an outline, a set of guidelines or guideposts that Congress would fill in as it went forward, I think that would go a long way to reducing uncertainty, increasing confidence, and addressing one of our biggest longer-term problems.
Thank you, Mr. Chairman.
Senator Brown.
Thank you, Mr. Chairman. Chairman Bernanke, nice to see you. As you know, as a result of Dodd-Frank, the Federal Reserve has gained a great deal more authority to oversee U.S. banks. Regulators, we know, all of us agree bipartisanly, have a responsibility to ensure that firm rules are in place, that rules are being followed, that bad actors are being punished. Unfortunately, as we all know and read day after day after day, since 2008, we've seen too many examples of Wall Street, again, breaking rules and laws governance and common standards of ethical behavior. I follow up on some issues that Senator Vitter talked about, and I just want to just run through it for the sake of repetition, because it's so important to continue to recognize what these problems are. Investor lawsuits, SEC enforcement actions over mortgage-backed securities, municipalities sold overpriced credit derivatives, bankrupting some of them. 5 of the nation's largest servicers found to have forged foreclosure documents and mortgage security legal documents. The nation's largest bank in January halted all consumer debt collection lawsuits over concerns about poorly maintained and inaccurate paperwork. The nation's largest bank has lost $5.8 billion to date on large, complex derivative trades that regulators either didn't know about or looked the other way. It appears their employees misreported losses. 16 global banks are suspected of manipulating LIBOR, that is used as a benchmark for mortgages and credit cards and student loans, and as you know, even derivatives. In June, one publication reported on a criminal bid rigging trial exposing illegal practices by many Wall Street banks and arranging bids so that banks could underpay for municipal bonds. 2 weeks ago, former employees of the nation's largest bank told the New York Times the company urged them to steer clients to their own mutual funds because they were more profitable for the bank, even though they paid investors lower returns than other funds. The Federal Energy Regulatory Commission is investigating whether the biggest U.S. bank manipulated prices in the energy market. I mean, this goes on and on and on and on, not to mention wrongdoing in institutions over which the Fed has no jurisdictions. MF Global, PFG Best, the problematic Facebook IBO, recent reports and the analysts at Wall Street's biggest banks are sharing secret information. I mean, no wonder the public doesn't trust you or us or any of the banks on Wall Street, the bank regulatory system. So I don't know any other answer, Mr. Chairman, other than to put out there and again say I think so many of our biggest banks are too big to manage and too big to regulate. I think this behavior shows they're too big to manage and too big to regulate. True?
There have been many bad practices, I agree. Many of them are tied to the crisis period, a period of excess. I think that's bad business. I think it's important for us to address those issues through enforcement. And of course, part of the reason, I'm not overclaiming here, but part of the reason you could make such a long list is that so many of these things have been turned up by various enforcement.
And perhaps many haven't.
Perhaps many haven't, that's true.
Mr. Chairman, I apologize to interrupt. It's not really fair, but you said this is bad business. Well, for a lot of them, it has been kind of good business. It's been it's been embarrassing to some, but it's also meant bigger and bigger profits and bigger bonuses. And to say it's bad business from an academic viewpoint, from a perch at Princeton perhaps, but it's not good for our economy, but it's been far too many rewards for some of the bad actors.
It's very short-sighted. It's not the way you build a long-term relationship with customers and not the way you have long-term profits. On the size of banks, I think the real issue is too big to fail. If you conquer too big to fail, then there will be strong market pressures for banks that are too big to manage, too big to operate, to break up. There was a story about that in the media this morning about the benefits of providing shareholders with additional value by breaking up in situations where you don't have good controls and you don't have good synergies between different parts of the bank. And so what Dodd-Frank does is provides a blueprint for attacking too big to fail, and that includes the liquidation authority. It includes the living wills, which, by the way, do provide a blueprint. If you wanted to break up banks or hive off parts of banks, the living wills provide some information about how you would do that in a sensible way. So I think it's very important to attack too big to fail, and we're addressing that through capital, through supervision, through orderly liquidation authorities, through living wills. And I think if banks are really exposed to the discipline of the market, that we'll see some breakups of banks.
Living wills seem to take effect, at least in the non-financial world, only on close to somebody's deathbed, and I don't think these living wills address the issue, nor does this other kinds of regulations seem to address the issues of all of this litany of problems I mentioned. I mean, it's in the end, if these banks can be regulated, then it seems clear to me at the Fed and other regulators that includes the far too often captured by the regulators OCC, that they're either not up to the job or they're complicit in Wall Street's activities. I guess I beg of you to figure out how we're going to restore confidence to the American people in the financial markets, because we certainly haven't yet.
That's a high priority. I agree.
Thank you.
Senator Toomey.
Thank you, Mr. Chairman, and thank you, Chairman Bernanke, for being here. I just want to touch briefly on monetary policy before moving on to the LIBOR scandal. And, Mr. Chairman, you acknowledge that there's a range of views about the efficacy of the policy that you've been pursuing. I'm sure you'd also acknowledge that there's a range of views about the risks that are associated with the policies you've been pursuing. And I will acknowledge that I'm sympathetic to the fact that we've given you a dual mandate, which I think intrinsically creates the risk that you'll be put in a position where you have to deal with the conflict over two conflicting goals. But I just want to stress, and I know you and I disagree on this, we've had this conversation, but I just feel strongly that the problems facing our economy are not monetary in nature. They result from this ongoing deleveraging process that we are suffering through, a regulatory avalanche, completely unsustainable fiscal policy, which you've acknowledged, and the threat of huge tax increases. And so to address this with ever easier monetary policy, I worry very much about the unintended consequences, including the fact that it has the effect of masking the true cost of these deficits and making it easier for us to continue this very imprudent fiscal policy. So I just want to reiterate that point, but what I'd like to ask you about, if I could, is this LIBOR scandal, and I will tell you I'm very disturbed about this. I'm disturbed about the destruction of what little confidence might remain in our financial system. I'm very concerned about the direct impact to American citizens, including my constituents. Among many, I think of the city of Bethlehem that engaged in interest rate swaps where they were paying a fixed rate, receiving floating rates based on LIBOR, and I wonder whether they were systematically receiving that were lower than what they should have gotten because of this. You had mentioned in your testimony, or perhaps in answer to a question, that Fed officials became aware of Barclays manipulating this index in April of 2008. The Wall Street Journal has an editorial today in which they recount
Around the clock, around the world, Bloomberg keeps you connected. On television, online, on the radio, and on mobile.
an accurate representation.
I agree. I get my question, though, and you mentioned observable market transactions would seem like a better way of doing it than a survey of banks. That sounds sensible to me. The question is, why have we allowed it to go on the old way when we knew it was flawed for the last 4 years? With trillions of dollars of transactions.
Because the Federal Reserve has no ability to change it.
You have enormous influence over the institutions engaging in this.
We have been in communication with the
and as you point out, there are other ways you could establish a perfectly viable floating rate that wouldn't have these problems. And as you point out, there are other ways you could establish a perfectly viable floating rate that wouldn't have these problems. I'm just very surprised that this was allowed to continue for so long when
making, I think, some very good suggestions about how to clean up. Well, again, Senator, the New York Fed took the lead in making, I think, some very good suggestions about how to clean up.
Last July, Chairman Bernanke, last July we discussed experiencing a jobless recovery. You agreed then that the long-term unemployment was a major problem and recommended that Congress take a look at ways to help the unemployed. Things like training and education. Of course, the Federal Reserve has its own mandate to keep unemployment low, and we keep
in Asia as well. The Chinese GDP statistics have been weaker this year than in previous years. Partly that was intentional as they sought to cool their housing market and to address inflation concerns. But there is a slowing in the global economy. To the extent that actions taken by our trading partners strengthen their those economies, it'll help us on the margin because it'll increase our markets and provide an overall better economic environment. But I would say at this point that compared to what we saw during the aftermath of the crisis, nothing is happening globally of that